From the CUBE studios in Palo Alto and Boston, bringing you data-driven insights from the CUBE and ETR. This is Breaking Analysis with Dave Vellante.
Earnings reports from the big three cloud players disappointed investors this week. All three US hyperscalers fell a little bit short of consensus for their cloud revenues in the December quarter, and investor reaction has been negative. But when you squint through the data, there's a lot to like about the position of AWS, Google Cloud Platform, and Microsoft Azure. In particular, the IaaS and PaaS revenue alone for these big three approached $200 billion in 2024 and grew at a clip of 25%. All three companies cited capacity constraints, given strong demand, and along with Meta, are committing more than $300 billion in CapEx spend this year, most of it to support current and future AI demand. You know, as is often the case, when a new wave hits, it tends to be overhyped at the beginning of the cycle and underestimated when it hits a steady state. And in between points A and B, we often see blips and bumps that represent opportunities for long-term investors. Hello, and welcome to this week's theCUBE Research Insights, powered by ETR. In this breaking analysis review, we review the latest quarterly reports from the cloud giants and update our 2024 market data for IaaS and PaaS with some survey data from ETR that shows Google making strong progress in AI despite the latest concerns from investors. Let's start with a quick look at the reaction investors had to earnings prints from Microsoft, Alphabet, and Amazon. Here's a 5-day price chart for those three firms as of this morning. By no means were these bad reports, but all three came in just slightly under consensus, particularly for their cloud businesses. At the same time, all three were hit with higher than forecasted currency headwinds. As an example, we tweeted out Thursday morning our expectation that Amazon would report $29.1 billion in AWS revenue, and they came in at $28.8 billion, just under our forecast. But if you adjust for FX headwinds, we estimate the number was pretty much right on our forecast. Now, all three are experiencing triple-digit AI growth, and each company cited, as I said before, capacity constraints. Not surprisingly, all three can now run DeepSeek in their clouds. You may recall last year we said that AI would compress server cycles. And Amazon reported that AI is accelerating server cycles and will make changes to its depreciation schedule and shorten the useful life of certain equipment from 6 years to 5 years, which will impact the income statement in a negative way. You might remember Amazon elongated that cycle several years ago, and that helped the income statement. Now we're going the other direction. It's just accounting. But the big story remains CapEx. Short-term traders, they don't like when companies spend gobs of money for long-term benefit. They want it all now. They want trees to grow to the moon, as the saying goes, and they want CFOs to beat and raise every quarter. Beat and raise, beat and raise, beat and raise. Just doesn't work that way. That's not how markets are. They're choppy. They're sometimes ugly and often unpredictable. Now, with that said, Sundar, Satya, Andy, and Zuck are ignoring the market reactions and doubling down on their CapEx spend this year. Just look at the forecast for spending in 2025 compared to 2024, which, by the way, was enormous in its own right. In 2024, these four firms spent nearly $250 billion in CapEx, and they're increasing that by 38% collectively this year. Despite all the concerns about DeepSeek, these companies are loaded for bear in a high-stakes game of poker that they believe is not a winner-take-all scenario because the market is so large. Is the market's reaction to DeepSeek wrong? Or do these CEOs, all of whom clearly buy into Satya Nadella's comments about Jevons paradox, see the world differently? Well, consider this. In a recent ETR flash survey, 68% of respondents said if AI tools were less expensive, their organizations would be investing much more in AI. And history in the tech industry says that number is probably understated. What's more is the cloud is throwing off cash. Even Google Cloud Platform, which was burning cash until last year, is showing progress on the bottom line. Just take a look at AWS's results to see how profitable the cloud is at scale. AWS's operating profit last quarter was $10.6 billion, or 38% of revenue. That's an amazing operating margin, up from $7.2 billion, or 30% of revenue from a year ago. A nearly 50% increase in operating profit. That's on a business that's running at a $115 billion annual rate. And I mean, essentially, this is an infrastructure business. Hardware companies, they're lucky if they can get 1x or 1.2x revenue. What would the valuation of AWS be if it were a standalone company? I don't even want to go there. And to reiterate, AWS, along with other two US hyperscalers, they're capacity constrained by chips and other certain components, motherboards and things like that. Okay, so let's look at the numbers in more detail. Here's our annual look at the IaaS and PaaS markets over the last 5 years. We're showing the big three US players plus Alibaba accounted for $210 billion in revenue in 2024. And that's 128% growth on a $200 billion market, with Azure and GCP growing in the mid-30s. Now, as you may recall, in 2023, we adjusted our Azure figures to strip out some of the non-cloud revenue, and then Microsoft restated its definitions in 2024, which we account for here. You might remember the whole Microsoft Activision and the leaked documents, all that. We've accounted for all that to try to create as much of an apples-to-apples comparison between AWS, Google Cloud Platform, and Microsoft Azure as possible. Now, you notice AWS has maintained a 50% share of the market when we just count the market as these four, big four hyperscalers. But it will drop below, it being AWS's share of the four. We think it'll drop below 50% this year for the first time. We'll be sharing our 2025 forecast in future breaking analysis episodes. Now, a note on GCP. Google Cloud overall grew at 30% in the quarter, but we had GCP growing at 36%, much higher than Google Cloud overall. And this is based on statements made by Google and our own estimates and our surveys. And remember, Google doesn't report a GCP revenue or a growth number. We have to deduce from breadcrumbs, like I said, surveys, other research that we do. Same with Azure in a way. Microsoft reports Azure growth rates, but it does not report absolute dollars, and it shifts around the deck chairs and changes its definitions. So we have to try to keep up with that. Now, they both do this because they don't want to concede anything to the leader, AWS, in IaaS and PaaS. What they want to do is put in their software businesses, which AWS doesn't have a large software business, and so they make apple-to-apples comparisons difficult. Now, the other key point on Google is its cloud operating margin is now approaching 20%, whereas a year or so ago, it was bleeding cash. And we're talking about the overall cloud. They don't report on GCP, but GCP follows suit. So Google, making great progress. Microsoft, AWS, and Google all report multiple billions of dollars in AI revenue. So you think about that, it's understandable that three firms spending more than $200 billion in CapEx last year to capture the AI opportunity are only generating multiple billions from that investment. You can see why that has the market a little freaked out. Okay, let's go to some ETR data. Alex, if you'd bring up the next slide. This is a XY view that we like to share with you guys. And the vertical axis is net score, and that's a measure of spending momentum. On the horizontal axis, it says overlap here. That's the penetration in the data set, and we're showing the big four. Microsoft Azure in the upper right, AWS, Google Cloud, and Alibaba. Now, you might be wondering, well, wait a minute, Dave, you just showed us that AWS is larger than Azure. Why does the ETR survey show that Azure is larger than AWS? And that's because when we ask customers about who they're using for their cloud, they're including most certainly Office 365 and other SaaS software in their Azure number. So consider that. And again, the other point is this is account penetration. So it's maybe not so much that factor that I just mentioned, although we think it's some of that, but it's account penetration. It's not an indicator of dollars spent. Okay. Now, a couple of other points. On that red line at 40%, that indicates a highly elevated spending momentum. In the upper right, you can see the net score and the N, and that's what informs the plot. I don't put too much weight on Alibaba here because we only have 40N, but the other three put a lot of weight on. And this is, again, the cloud computing sector. So you can see Microsoft and AWS far to the right, Google Cloud Platform kind of hovering on that red line. Now, Alex, if you go to the next slide, please, what this shows is just the machine learning and AI sectors. And this is really interesting. Okay, so what do you see here? Same XY. What you see, however, is that AWS and Google, much, much closer here than they were on the previous chart. We've also added MetaLlama. You can see MetaLlama is way, way up on the vertical axis. Okay, so that's another interesting commentary. I included Data Robot in here just so we could have that 40% line. You can just ignore that. But all of these players are above the 40% line. But what's even more interesting here is look at that little table that we inserted here. It says survey ends, and we went back to January 2023 and looking at January 2025. Look at how Google is closing the gap in AI on AWS. Back in January 2023, AWS had 175 N to Google's 127. Or the bottom line there, the bottom row, Google as a percentage of AWS at the time was 72%. A couple things happened as we go out 2 years. The N's dramatically increased. AWS is now 379 and Google 346, but Google is now 91% of AWS, so it's closing in on its AWS competitor. So that just underscores Google's strong position in AI. And look, Google cites its strong tech stack, which we've always said it has. And so, Google, again, this is not a winner-take-all market. It's very rare that markets have three leading companies like we have today, but because the markets are so large, three companies can dominate and make a lot of money. Normally the leader makes all the money, number two makes a little bit of money, and number three barely breaks even or gets out of the market. It's the old Jack Welch, you got to be number one and number two in the markets. When the markets are this large, that's not the case. You can come up with highly differentiated strategies, as for instance, you can see now from both Oracle and IBM. Both have clouds, both are in the game. They're not at the same scale as the big three hyperscalers, but they have highly differentiated strategies that are winning. So you've essentially got, 5 companies and more. Add on to that Snowflake and Databricks. So these markets are just so enormous. So when we think about the negativism from the last earnings prints, just think in terms of the future size of the market. And this is why these 3 or 4 firms are spending so much money on CapEx, because the opportunity is so large. Okay, let's close with a few thoughts. I want to start with, we are witnessing a strategic realignment. Despite the short-term skepticism in cloud investments from investors, executive teams, they're making big bets on AI to drive innovation and unlock new revenue streams that will be massive. Let's look at cost versus opportunity. Now, investors are clearly wary of the soaring CapEx, but the potential payoffs from AI and the efficiencies that it can create are far too compelling for these CEOs to ignore. They would ignore them at their own peril, and they would end up missing the greatest opportunity in tech history. And they're going after competitive edge. As the cloud matures, next generation AI capabilities are increasingly going to be the things that define competitive advantage. And these leaders have to aggressively move to stay ahead of the curve. Now let's talk about market catalysts. You're seeing some financial headwinds like FX. They could temper cloud enthusiasm, but they also sharpen the industry's focus. The stakes are high. And what's happening is they're all accelerating their AI-centric initiatives, because that's where the transformative long-term value exists. In fact, in Microsoft's earnings call, they talked about execution in the non-AI portion of Azure, because they were so focused, i.e. the partners were so focused on AI execution, they kind of took their ball off the non-AI execution. So you're starting to see the schism that we talk a lot about in the market, where the new stuff is growing fast, triple digits, but it's not yet large enough to offset the declines in the old stuff. And that's what always happens in these market transitions. That's what always confuses the market. You got to have a long-term view. Whether investors lean in or pull back on the cloud, the foundational infrastructure it provides will continue to be a critical enabler for AI, positioning those who invest wisely today for outsized gains tomorrow. Last thing I'll say is lower cost to deploy AI. We saw this with DeepSeek. We firmly believe that as costs come down, adoption will explode. If DeepSeek tells us anything, it's to be prepared for whatever comes at us on this AI ride. Okay, that's it for now. Thanks to Alex Meyerson and Ken Schiffman on production and in our podcast, and Kristen Martin and Cheryl Knight, who helped spread the word on social media and in our newsletters, and Rob Hof, who is our EIC over at SiliconANGLE.com. Does some great editing. Thank you all. Remember, all these episodes are available as podcasts wherever you listen. Just search Breaking Analysis Podcasts. I publish each week on thecuberesearch.com and SiliconANGLE.com. You want to get in touch? Email me at david.vellante@siliconangle.com or DM me at dvellante. Comment on our LinkedIn post, and please do check out etr.ai for the best survey data in the enterprise tech business. This is Dave Vellante for theCUBE Research Insights, powered by ETR. Thanks for watching, everybody, and we'll see you next time on Breaking Analysis.